Hi, today we look at part two of capital budgeting exercises, and we'll be discussing this question, which is a little bit more complex than part one. This question has been adopted from an ACCA exam, and therefore the solution to this is useful to students taking ACCA and students of corporate finance at undergraduate level. Now, this is our question. Agbada Incorporated is considering a new investment which would start immediately and last 4 years. The company has gathered the following information. Asset cost $160,000. Annual sales are expected to be 30,000 units in year one and two, and will then fall by 5,000 units per year in both years three and four. The selling price in first year terms is expected to be 4.40 per unit, and this is then expected to inflate by 3% per annum. The variable costs are expected to be 0.70 per unit in current terms, and the incremental fixed costs in the first year are expected to be 0.30 per unit in current terms. Both of these costs are expected to inflate at 5% per annum. The asset is expected to have a residual value of 40,000 in money terms. The project will require working capital investment equal to 10% of the expected sales revenue. This investment must be in place at the start of each year. Corporation tax is 30% per annum and is expected and is paid 1 year in arrears. 25% reducing balance, writing down allowances. This is depreciation on the asset available on the asset cost. General inflation is 4%, and the real cost of capital is 7.7%. 12,000 has already been spent on initial research. Required, calculate the NPV of the proposed investment. 2, graphically show the internal rate of return of the project. 3, using Solver, find the internal rate of return of the project. And then 3, using Scenario Manager, find the NPV at the following asset cost: 140,000, 150,000, 170,000, and 180,000. Part 5, explain how firms create positive net present value projects. Will not attempt part 5 because that is a textbook question which you can read textbooks and answer. Now, having adopted this from SCCA exam, what was picked from SCCA is the computation of NPV. Part 2, Part 3, and Part 4 were not part of the SCCA exam. Now, to answer this question, we need to put down our variables, and I've already written down the variables. So we have the asset cost, and this is a 4-year project, so we'll need to compute annual sales, the selling price, the variable costs, incremental fixed costs, selling price inflation, cost inflation, asset residual value, working capital, corporation tax, depreciation, general inflation, real cost of capital, and the research costs. Good. Having said that, we'll start by putting in the variables. So what is the asset cost? We are told the asset cost is 160,000. So you type in 160,000. What are the annual sales? Annual sales year 1, 30,000. Year 2, 30,000. And then year 3, it's expected to fall by 5,000. So that will be 25,000. And then in year 4, it falls by another 5,000. So from 25,000 to 20,000. Next, we have the selling price. Selling price is $4.40 per unit. We'll then inflate this later. We are simply putting in the variables, which will then link and compute the required numbers. Next, we have variable costs. The variable costs per unit are 0.70. Incremental fixed costs are 0.30. Then next, we look at selling price inflation. We are told selling price inflation is 3%. So 3%. Cost inflation, 5%. The residual value, according to this question, the residual value, the asset is expected to have a residual value of 40,000 in money terms. So residual value is 40,000. Working capital is 10% of sales revenue. So 10%. Corporation tax, according to the question, is 30%. Depreciation at reducing balance method is 25%. General inflation, we are told, is 4%. Real cost of capital is 7.7%. Research costs, 12,000. So we have the first part of this question. Now, what we need to do next is to get our selling price in year 2, 3, and 4. So what were we told? We were told selling price will inflate at 3%. So what we do is come to year 2 and say equals 4.40 per unit, put $sign. If you are using a MacBook Air, you press Command CMD and then T. That will put $sign on that cell, and therefore it becomes an absolute cell. It means constant, it will not change. So multiply this by 1 plus, so 1, put $sign plus the inflation rate for selling price, 3%. Put $sign on that, close the brackets, and then say power 1, because this is the first time the selling price is going up. So power 1, then enter. So our selling price in year 2 is 4.5. Then copy this to year 4. So in year 4, our selling price is 4.808. Next, we come to variable costs. And it is good to be guided by the question. What are we told about variable costs? Let's go up. So we are told the variable costs are expected to be $0.70 per unit in current terms. When we say in current terms, what we mean is in year 0 terms. Current terms is now, and now is year 0. So now we go to year 1 and say equals 0.7, put $sign, multiply by, put brackets, 1, put $sign plus, the variable costs will inflate at 5%. So plus 5%, put $sign, power 1. So 0.735. Copy this across and you have 0.851 in year 4. So that is computed correctly. Next, we have incremental fixed costs. So again, we go up to the question and check. The variable costs are expected to be 0.70 per unit in current terms, and the incremental fixed costs in the first year are expected to be 0.30 per unit in current terms. So, because it is current terms in year one, that will mean you inflate it. So we'll come to year one and say equals, inflate this, multiply by brackets, 1, put dollar sign, plus the inflation. Incremental fixed costs inflation is also 5%, power 1. So we now have our incremental fixed costs. So we've computed two crucial numbers, the selling price and the costs per unit. So the next thing we need to do is to look at the depreciation component. So we'll go up and say, this is computation of depreciation. For asset cost. Now, what you need to do is to link cells. So asset cost, you say equals, and then we look for the asset cost. Asset cost is 160,000. So we picked it from our variables. So that if I change this 160 to 150, for example, yeah, you will see under depreciation, the asset cost has changed. That is the reason we are linking. Okay, so we are told depreciation is at 25% and it is on reducing balance basis. So we take down allowance for year one and it is 160,000 multiplied by 25%. That is 40. Balance. Our balance, writing down allowance for year one. So that is why it is called reducing balance method. So the next one, writing down allowance for year two, will be computed based on the new balance, which is 120,000. So say writing down allowance year two equals 120,000 multiplied by 25%. That gives you 30. Get the new balance. 20,000 minus 30,000. You get writing down allowance for year three. Writing down allowance for year three is 90,000 multiplied by 25,000. So balance 22,000. Now, when we come to year four, number one, we are told there is a residual value. And the residual value is 40,000. Again, we link. So you say equals, you pick it from where our variables are. Yeah. And we are told asset residual value, 40,000. So we pick it from there. Enter. Then we look for the balance. The balance is 67,500 less 40,000. So the writing down allowance for year four is 27,500. This is our balancing charge. This is our depreciation for the last year. Now, we've computed the depreciation. The next thing you need to compute is sales revenue, so that on the basis of that, we are able to compute the working capital. So we'll come here and say, this is year 0, this is year 1, year 2, year 3, and year 4. But because we are told tax is paid in arrears, the tax for year 4 will be paid in year 5. So number of years will go up to year 5 for purposes of tax for year 4 shifting to year 5. So sales revenue, we say equals, we pick the annual sales, multiply by 4.4. And that gives us 132,300. Copy this to year 4. So that is the sales revenue. Now, we want to compute, we want to compute working capital. So what we'll do, we'll come here and say, we have here 0. Let me put it here, working capital. So working capital. We have here 0, here 1, here 2, 3, here 4. Now, our working capital for year 0, because you require working capital now to start the process of production. So working capital for year 1 will appear in year 0. So I'll take the sales revenue, 132,000, multiplied by 10% is our working capital. Enter. That gives you 132,200. Then take these two. Sorry, you need to put $sign on 10%. Because the 10% will not change. Okay, so we have the numbers there. Now, for working capital, 132,200 is the sales revenue for year 1. And therefore, 10% of that should appear in year 0, meaning now, so that we use this working capital for our production process. Now, what you require is incremental working capital. So if it is 13,200 in year 0, and in year 1, this figure will move to 13,596. It means it is a top-up, which basically means 13,596 minus 13,200. So if you top up by 396, you get 13,596. And using the same logic, we go up to is the upper one. Okay, so that is what we have. The incremental is 396. When it comes to year 2, the incremental is negative, meaning we withdrawn cash from the business. We've reduced our level of working capital. And then in year 3, again, we've reduced our level of working capital. So we've computed the incremental working capital. So what we need to do next is to now get our earnings before tax. So we have our sales revenue. We want to compute the variable costs. So we say equals annual sales multiplied by variable costs per unit. And then because costs are negative when you are looking at working capital budgeting, cash inflows are positive, cash outflows are negative. So I'll put a negative on the variable cost per unit. Next, I come to fixed costs. So I say equals 30,000 put $sign on 30,000, multiply by negative the incremental fixed costs. Why have I fixed the 30,000 for year one? It is because one will not use the sales of 20,000 in year four to compute what our fixed costs will be. We use the year one fixed costs. What is changing is the incremental fixed cost per unit. Because if you go by the annual sales, your numbers for fixed costs will ideally not be correct. Okay, let me first get the numbers and then I'll explain. So you have 10,418 in year 3 and 10,939 in year 4. So let me click on 10,418. Yeah. So it is 30,000, the units for year 1, multiplied by the incremental fixed costs. Incremental fixed costs, but based on the figure of 30,000. If they were not incremental, what would I have done is to take 30,000 and multiply by the incremental fixed cost per unit. So whether the number of units go down or not would have kept our figures constant. But because it is incremental, what we are fixing is annual sales. Yeah, annual sales for year 1. And then we let it vary with the cost per unit. Next, we pick depreciation, so equals minus. We pick our depreciation figure for first year, which is 40,000. Then we go to the next depreciation figure, year 2. Then year 3 equals minus, year 3 is 22,500. And then finally, year 4, we pick the balancing charge of 27,500. Now, we have our numbers for the expenses and our numbers for the income. So the next thing you need to do is revenue minus expenses. So you have $60,500, and in the final year you have 40,703.33. Then we can compute tax. So tax, say, equals 60,500 multiplied by 30%. Put $sign on 30%. And this gives us our taxation figures. Next, we now compute the cash flows. So you start off with earnings before tax. So equals, we pick earnings before tax. And then we come to tax. We are told tax is payable in arrears, and therefore tax for year 1 goes to year 2. And what is tax? Tax is a cash outflow. You are paying the tax authorities, so cash will go out, and therefore it is a negative. So equals minus. You take this to year 5. Next is depreciation. We add back depreciation. Why are we adding back depreciation? We are adding back depreciation because depreciation does not involve cash outflow. It is treated as an expense for purposes of tax benefits, but it does not involve movement of cash. So we add it back. So equals minus, that will make it a positive. Next, we pick our working capital. Now, working capital will start from year 0. So cash flows from year 0, 1, 2. So year 0, we say equals minus, because you are paying out, yeah, because you are investing in working capital. So we pick our figures for working capital. The figure for year 0 is 13,200. Sorry, 13,200. And then we pick figures for year 1, year 2, up to the end of our project, which is year 4. Now that we've invested in working capital, at the end of the project, it is expected that you will recover your investments in working capital. So what we do is our investment in working capital and then make it a positive because we are recovering. So we recover what we had invested in working capital. Then next, we require the cost of the asset. So equals minus, cost is also a cash outflow. We are paying out for an asset. Then we are also told there will be a residual value, and the residual value comes in year 4. So we go to year 4 and pick the residual value. Now we've picked all the cash flows of this project. So now what we require are the net cash flows. So you say equals sum. Pick the cash flows from earnings before tax up to the asset cost. And then copy this up to year 5. Don't miss out year 5 because for net present value or discounted cash flow methods, all the cash flows are relevant. So even the cash flow for year 5 is relevant, even though this is a 4-year project. The tax for year 4 will be paid in year 5. Then next, we need to compute the discount rate. Now, we are given the general inflation and we are also given the real rate. Now, what you require is the nominal rate. And to get nominal rate, I'll say NR for nominal rate. So nominal rate plus 1 will give you 1 plus F multiplied by 1 plus the real rate, which is RR. And for our case, RR is 7.7%. But what you require is the nominal rate. And therefore, it becomes, if you want NR only, nominal rate, your formula will become nominal rate is given as 1 plus F multiplied by 1 plus real rate minus 1. So I've just taken the 1 here to the right. So minus 1. So when we come here, the discount rate, we'll say equals brackets 1 plus the inflation rate. Inflation rate is 4%. Close the bracket. One plus the real rate, which is 7%. 7%. Close that bracket. Minus 1. So it is 12%. So I'll write it below. So this is 12.008. This is the number I'll be using as we compute our MPV and other, as we look at the other parts of this question, the solver, etc. So now I want to get my MPV of the project. So I come here, I go to FX, which is function. And if you go to your right, you'll see formula builder, MPV. So I double click on MPV. I pick 12.008, the one in red. Then when it comes to value 1, I'll pick values from year 1 up to year 5. So pick year 1, 2, 3, 4, up to year 5. And then say, okay. Now, we've picked the cash inflows. Now we want to pick the initial investment. So you come here and say add the initial investment, which is negative 173. There is a mistake. I don't know where the mistake is coming from, but there is a mistake because I didn't put percent here. So this is percent, 12.00, sorry, 12.008%. Then we go back to our MPV. So MPV, the rate is 12.008. The values are from year 1 to year 5. And then you say, okay. Then you come back here and say, add year 0 cash flows plus year 0. Year 0 is 173,200. Then enter. Our MPV is 88,186.34. So we finished the first part, and that is what was expected. Where I got the question, this is what was expected of you. So you get the cash flows, you compute it, you show your workings on a piece of paper. We made it easier because we are using Excel. So on a piece of paper, you show all your workings, then get to the computation of tax. After computation of tax, you get to the computation of cash flows. So you're able to compute the NPV of the project. Because the NPV is positive, you say you accept this project. So that is first part of the question. The second part is to show the internal rate of return of this project. Now, we can tell the internal rate of return of this project using goal-seek. So first of all, let's go to goal-seek. So you go to data, and then you will see what if on your right. So what if, click on goal-seek. So you say, I want my NPV to value 0 by changing my discount rate. So we can tell what the IRR of this project is. The IRR of this project is 35.9%. So if you are generating your discount rates, you have to generate from 0 to beyond 36%. Okay, so let me undo that. Okay, so we want to generate the discount rate. So you come here. Let me go down so that we can generate. So I'll say this is the rate. This is NPV. So 0%, 1%, 2%. So I generate this up to, I have to go beyond 36. So 39 is good enough. Then I come here and say, okay, which formula gave me the NPV of 88,186. This is in dollars. Disregard what it is showing there. It is in dollars. So you can go to currency here and change it to number. So that we discard the KS. Those our figures are in dollars. So $88,186. So double click there. It will show you the formula that gave you that NPV. And that formula is NPV equals NPV brackets B99, comma, then from C96 to G96, you close the brackets and add the initial investment, which is B96. So that is the formula you will type against 0%. So equals NPV brackets, pick it correctly, it will show. So comma, then C96, it has picked it correctly, up to G, it has picked correctly, plus the initial investment, which is this figure of 173,200, which is B96. So B96. Enter, and you have 88,186. Now we want to generate NPVs at these given rates. So what you do is you highlight this up to the end, and then you go to data. So data, go to your right up to what if, pick data table. And because what you see here is in column A and column B, you put your cursor in column input cell. And what do you want? You want NPV to generate for you. You want Excel to generate for you the NPVs at these given rates. So you click on the discount rate and you tell NPV, okay, generate. And it generates for you. Yeah. So at 12%, you can see it's around 88,228. Yeah. Okay, so that's very close to what we have. Now, because we've generated the NPVs at these given rates, what we require next is to get the graph. So to get the graph, start from 1% to your 39%. Then you go to insert, look for your charts. So the charts are here. Pick XY scatter, XY scatter smooth. So click on that and you have your graph, so you can extend it. Now, this is moving by 5%, 5, 10, etc. So double click here on 5, then it will give you format axis. So you can see the major unit is 5. We want it to be 1. Then you enter. So now it is showing you, if you make your graph a little bit bigger, you can see the IRR of this project is very close to 36%. We know it is 35.9, very close to 36%. So you know your chart is correct. So we now have our IRR graphically between 35 and 36. You can see at 35%, the NPV is 2423.56. At 36%, it is negative 173.91. So it is between 35 and 36. Now we used GoalSeek and we found it was 35.9. So that is the second part of that question. Let's go to the third part of the question. The third part of the question is Using Solver, find the internal rate of return of the project. Why are we using Solver? To get the same thing that GoalSeek gave us. GoalSeek did not give us an output or a sheet that we can look at or that we can print out. And that's why we want to use Solver. So it's the same. You go to tools, Solver,